Okay, you guys can see the screen now?
I was moving when I was shooting.
Yeah, we can see it now.
Okay, excellent. All right, so as I was saying, we're going through accounting, financial statements, financial ratios, and then managerial accounting. Okay, we're going to start off with this question, right? So these things, what do these things have in common? Any thoughts? You gotta show me a hand to see if I can see it. All right, so we got a bowl of salt, we got an animal skin, we got a bar of gold, we got some cigarettes, we got a cow, we got a seashell, we got some wheat. Who wants to guess? Yeah, Annika.
I think they were all tradable. Can you hear me?
They're all what? Sorry, say again. Yeah, I can hear you.
I think they are all tradable.
They're all tradable. Okay, okay. They're all tradable. Okay. All right. Now?
It doesn't matter who I'm right for.
Sorry, my mute button takes a while. I was gonna say it's all things that are like sold and bought. So
sold and bought, they're tradable. All right. Okay. Anybody else? Any thoughts? Yeah, we got somebody else. I can't. My screen says 3 participants raised hands, but it doesn't tell me who it is. So whoever it is, go ahead.
Were they all used as currency?
Ah, okay. Yeah, there we go. That's what we're really getting at. Excellent. These are all items that have been used as money in the past. It's used as currency. It's used as something that was used to trade. So it brings us to this question of what exactly money is, right? And this is a question that, frankly, you know, the more you kind of think about it, the less sense it makes. So it's sort of something that you don't want to get into so far. But the standard definitions that you hear are these 3 things. It's money is a medium of exchange, something that you can exchange for something else, right? That facilitates a transaction. It's a unit of account, meaning that it's something that tells you what. It's something that allows you to compare between different things. So let's say you have a house and a car. How can you compare those 2 things next to each other? Well, one way you can think about it is, well, how much money is this house and how much money is this car? It's basically putting those both things, both the different items in the same unit, in a money unit, so you can start comparing them with each other. There's a unit of account and there's a store of value, right? So if you have something that's valuable, right, and you sell it, then where does that value go for you? The other person has the thing, right? But then you have the money. The money is the thing that's telling you where that value is. Now, we're going to be focusing mostly on this side of things. It's the medium of exchange, the transaction aspect of money, right? When money changes hands going from one place to the other. So you've got this exchange or transactions, which lead to these financial flows, money going from one place to another place, from one person to another person, from one bank to another bank, and so on. And the accounting piece is keeping records of all of these flows. What's happening? Where does this money going? Where's it coming from? Where's it going? That's what the accounting is keeping records of, to keep track of. And why is this important? Why is this useful to keep records? How do those records get kept? What records do you keep? And how do you prevent errors in the record keeping? These are all the things that accounting thinks about. Okay. Now, to start off with this, right? To start off with this why keep records question, I like to tell this little story of the island of Yap, right, in the South Pacific. Does anybody know anything about the island of Yap? Here it is, Yap Island. You know, anybody know what's famous about the island of Yap? Why Yap is a famous place? Anybody? No? Okay. Yeah. Do we have a guess? I heard a noise. No? Okay. Well, Yap actually has the most money in the world. Well, that's not exactly true. It's not the most money in the world. What Yap has is the biggest money in the world, right? The largest pieces of money, specifically coins, the largest coins in the world. This is a Yapese coin. This is a Yapese person from the island of Yap, and this thing over here with the hole in it, this big giant rock, is a coin. This is their currency. This is Yapese money, right? Now, if you have money that's this huge, right, this big giant rock, obviously you can't really use this as simply as, let's say, a dollar bill, right, which you exchange directly for goods and services. You can't carry this thing around. It doesn't really make any sense. Yeah, it has to kind of stay in one place. So the question is, well, how do you know whose money this is, and how do you keep track of exchanges, right? Right? How do you know what's happening? How does this thing function as money? Well, the answer is that basically every Yapese, this guy knows who owns how much of any of this coin, right? Because there's not that many Yapese, and everybody knows every transaction that's going on, right? So everybody just sort of has it in his head. Yeah, I know that Bob owns that, and Susan owns this, and Mo owns this, and Jane owns that, and so on. This different pieces of money, right? And every time a transaction happens, that transaction is essentially stored in the Yapese head, right? And every Yapese knows who has how much of this money. So what we have is what we call a distributed ledger. Each Yapese person knows all the transactions that have happened with all the different pieces of Yapese currency that's out there. And they all have to agree with each other, right? And so you reach this consensus between the group, and that's what determines essentially who owns what, who has how much money, and who has the rights to any particular item. Now, there's a story where if this is going on, there's this story. The way they got those big giant stone coins is that there's no quarry, there's no source of stone on the island of Yap itself. So the Yapese, they have to take their outrigger boats and go to another island where the quarry is. Then they have to quarry out these big giant stones, and then they got to bring them back in the canoe, right, back to Yap. And so what happens sometimes is that you lose the coin. In fact, there's in the harbor in the island of Yap, there's a whole bunch of big giant coins sitting at the bottom because they fell off the canoe and they sank. Now, the Yapese understood that really doesn't matter, right? It doesn't really matter where that coin is. All that really matters is people know who own it and what the transaction were that were related to it. So the point is that as long as you have this distributed ledger, as long as everybody's keeping track of who's spending what where, and who owns what, and who's selling what, and who's buying what, then the money itself, the existence of the physical money, doesn't really matter a whole lot. And that's what the importance is of creating the records. And we'll get back to why that's such a critical thing. Now, just a little bit of an aside, this entire situation here where you have a bunch of different people who are all keeping track of exactly the same transactions, and the way they know that the transactions are legitimate is because they all agree on that transaction. This is, as I said, it's called the distributed ledger, right? It's a big deal right now. If you look in the sort of fintech world, you'll hear a lot about distributed ledgers. It's a little bit different than what we normally have, which is a centralized ledger, right? In a company, you've got one account that's pulling things in from lots and lots of different places. This is a centralized ledger, right? You could have it decentralized. Different places have different nodes. But in the distributed ledger, everybody has a copy of everything. It's all in the same place. And this is actually the basis of what you may have heard. It's called Bitcoin and blockchain. This blockchain that they talk about is the distributed ledger. Is the ledger. Instead of keeping it in people's heads like the Yapese do, this is kept on your computer. But the principle is exactly the same. It's a complete record of all the transactions that have happened, right, for a certain currency or a certain type of money, and everybody is essentially keeping a record of it. So nobody, it's very, very difficult for anybody to cheat because you have to match what everybody else is doing. Now, this distributed ledger here, the blockchain, the currency that it's dealing with normally, as we talk about, is Bitcoin. You probably also hear about, right? So it's this distributed ledger, but we don't have to go into a whole lot of detail here. It's just to show the relationship between the island of Yap and Bitcoin. It's probably not something that you think of all that often. But getting back to our ledgers, the records that we are going to be using is the centralized ledger, right? So this is what's called a general ledger account. This is a series of transactions, right? This is a list of what transactions are happening. This is a kind of an old ledger. You can see each line is talking about different transactions that are happening. So when you have this record, when you're trying to keep a record of transactions, then it gets to this question when you can do this, right, what happens is that, as we said, you don't actually need physical money, right, to keep track of any of those transactions. It doesn't really matter. So what that allows us to do by keeping records like that is it allows us to have much larger amount of money supply than we actually have in currency, right? So you can see the currency portion of our money supply, the actual dollars, the bills, and the coins that are out there in circulation, isn't really all that much, right? Most of the money that's out there, all of this different money that's out there, are just, you know, numbers in bank accounts somewhere, in computers somewhere. Not a whole lot different, frankly, than the coins sitting at the bottom of the lagoon in the island of Yap. Okay? So that's what's really sort of important about keeping records, because once you keep records, the actual physical money doesn't really matter anymore, and you can have tons and tons of additional economic activity without creating any more currency. Right? That's what's happening there. So how does that work? How do you keep records? What records do you keep? How do you prevent errors? Well, we talk about the invention of bookkeeping by this guy Luca Pacioli in the Renaissance in Florence. But really, when you go back in history, you'll find elements of this in the Near East. This is, I think, in Iraq or perhaps Jordan. Right? You also see it actually in ancient Korean history, where there's this type of bookkeeping going on. But we call this, what it's based on is this idea of double entry bookkeeping. It's based on an accounting equation. We'll get back to this in a second, what the specifics of all this are. But the thing to think about is right here, equal sign, right? There's a relationship that's going on. There's all these equalities that are happening, right? So that means that, you know, with any equal sign, if this thing gets bigger, one of these two things needs to get bigger. If this thing gets smaller, right, and this thing stays the same, then this thing has to get smaller, right? So you've got all of these accounting equivalencies, right, that we'll talk about in a second, right, that determine how all of these things are working. So you've got the equal sign here. You've also got some equals going on here, right? So you've got this and this make that. This, and this, and this make that, right? There's all these different relationships going on that keep track of what's happening with the records, and make sure that you're not making mistakes, because if you make mistakes, then you're going to throw some things out of balance. The big innovation that came in accounting in the Renaissance was well, more actually older, but we credit it to the Renaissance, is this idea of double entry bookkeeping. What's happening here is that every time you make a record of a transaction, you actually do it twice. The idea is that any transaction, any exchange, right, has got to have two components to it. It's going from one place and going to another place. And so if you keep track of both of those things, where's it coming from, where's it going to, that helps you balance the entire thing and make sure that it worked out right. So you've got these two elements here, the journal, where you're recording each individual transaction, let's say by a different department. This is, let's say, the finance department talking about, we just received a loan from a bank of $10,000, and that $10,000 is now going to our cash account, right? So we've got $10,000 in cash, but now we owe $10,000 to the bank. That is two entries that we make, okay? And they balance, and they have to balance each other. Similarly, if we sell something, okay, then we have $1,000 that we got in cash for the sales that we made. Well, where did that sales come from? Well, there's $1,000 from inventory that went out. So our inventory decreased $1,000 and our cash went up $1,000. Similarly here, we spent $500 on electricity, right? So our cash went down $500, but our electricity bill also went down $500, right? So you've got this dual entry going on where you're talking about where money is coming from for here the loan, right? And where's it going to? Into the cash. Where's money coming from? From a sale, and it's going to cash. Where's money going out? Right? Money's going out from cash. Where's it going to? To the electricity expense. All of these journal entries then get recombined into what we call the different accounts, right? So we've got a cash account, so these items here, cash, loan, sales, electricity expense, all of these are different accounts, and they get recombined. You can see the cash account is pulling in the cash from this transaction, and this transaction, and this transaction, right? The loan is pulling in from that transaction, the sales are pulling in from this transaction, the electricity is pulling in from this transaction, and you get these set of what they call T accounts. You can see they look like a T here, where you have these different items, the debits and the credits. Now, I'm not going to go into that. If you take the accounting course, they'll talk about that in great detail, and I can never keep it straight. There's this little chart that talks about the different types of accounts and when it's a debit and when it's a credit. You can see sometimes debits are increased, sometimes credits are increased, and I can never keep this straight. You don't have to really worry about it for now. But if you really are interested in the intricacies of that, the accounting class is a good place to go and think about that. But what's useful about that is at the end of the day, when you have all of those debits and credits lined up from all of the different accounts here, right? So here's the total debits that came from cash, the total credits and so on, the accounts payable. If you add up the total debits and the total credits, you have to get the same number. And if you haven't gotten the same number here, then you've made a mistake in your calculation somewhere. That's what allows you to keep a check on whether your accounts balance or not, right? That's where how do you prevent errors things come in. And that's why double entry bookkeeping was such a big deal, because it helped you clear those errors and keep track of the things that you're doing. Okay. Those items, the debits and the credits, these assets, liabilities, expenses, income, all this kind of stuff, this is what ultimately goes into the financial statements that we're going to be talking about, the balance sheet and the profit and loss. All of this, right, is right here, is the financial accounting, right? That's what we're going to be talking about now. Go into accounting disciplines. There's other parts of accounting as well, but the financial accounting is what we're going to be talking about. What financial accounting basically is presenting a view of the financial health or the financial condition, the financial status of your company or your organization, or nonprofit, whatever it is, to the outside world. So the financial accounts are externally facing, right? Usually the people that you're most concerned with facing externally is the government, right? And the reason for that is because the government is going to want your taxes, right? And you guys do government nonprofit accounting. Frankly, I put all of this stuff under financial accounting. This is from a textbook. But yeah, all of this stuff is externally focused. It's giving the external world a view of what's happening with the company or the organization that we're talking about. Okay, so let's stick with that. How do you give that? That's where the financial reports come in. Those financial statements comes in. This is what the CPAs do, the certified public accountants, right? So we're going to be talking about the financial accountant, the financial statement part of this. What are the annual, quarterly reports that a company is showing to the outside world? And at the outside world, this is what we see when we look at a company, right? So these are the financial statements that we're going to be talking about now. Now, I think the financial statement, it sounds, it can sound very technical and difficult and complicated and whatever, but I think it's actually fairly simple. I think if you think about what's going on there, you can essentially recreate the pieces of financial statements in your head. Okay, so the thing I want to ask you here right now is, if I asked you, let's say, as I said, the financial statements are there to give an indication of the financial health or the financial status, the financial condition, right, of a company or an organization. Now, let me ask you this. If you wanted to find out about those things, the financial health, the financial status, or the financial condition of a person, let's say me, if you wanted to know my financial condition, what are the things that you'd want to know? What are the things that you'd want to know about somebody to get a sense of where they stand financially? All right, what do you think? Give me a hand raise. Give me some guesses. Yeah, Janali.
How much you're earning versus how much you're spending.
Excellent. How much you're earning versus how much you're spending. All right, that's excellent. What else? Now, I can't see who's actually raising their hand. Hold on, let me see if I can do this. So, oh, maybe I can. Look at that. Okay, Maddie, what do you think?
I would say their debts, like what kind of debt they have and how much debt they have. Excellent.
Definitely, debt's going to be a big part of it, right? If I have a huge amount of debt, if I owe everybody in the neighborhood, then that's a very different financial condition than if everybody owes me. That's absolutely right. Uno, you have a thought?
Yeah, I was gonna say something similar. I was gonna say like asset to debt ratio. You can have a lot of debt, but you can have asset. Then
let's not get into the jargon right away, right? You used the word asset. Okay, what do you mean by that?
Like
Debt,
how
I
much?
understand. Debt is what I owe. What is it,
Yeah,
sorry?
like you could have a building, but you might not have cash. But if you have debt, you have to pay right away. Then you're probably in a
Right.
bad position.
So what do you mean by asset? That word that you use. What's that mean?
Types of money, I think I would say, like how
Okay.
fluid.
Okay.
Yeah, the amount of cash versus like building that you can't sell right away.
Okay. Buildings are an asset. Yeah.
Yeah.
Is that yeah? Cash is an asset.
Yeah, and like let's say I can also say if I have employees that they can be assets too.
An
But
employee can be an asset. Okay.
yeah, there are different types of asset.
But when I'm
So
talking personally, right? You know, from me personally, right? What are the assets that I have
like
as
house,
a person? A house. Okay. What
yeah,
else?
your job, I guess, like salary.
No. Okay. Okay. But financially,
Yeah,
the salary is what we already heard is the money that's coming in. Okay. Now the
your
assets,
property.
what property, yeah. So basically, the idea that we're getting to, right, is essentially the things that you own, right? What belongs to you, right? What is yours? Okay. So these are the four things that we're talking about. Janali started off with how much money is coming in, right? How much money is going out? Okay. So how much are you earning? How much are you spending? Okay. That's going to be an important part of it. How much do you owe? What is your debt? That's going to be a big part of it. And how much do you own, right? What are the different things that you own? Do you have a car? Do you have a house? Do you have do you have a stereo system? Do you have a bank account? Do you have stocks? Do you have bonds? What are all the things that you own? Okay, so these are the four things. These are the four critical things in any financial situation where you're talking about a person, you're talking about a business, you're talking about a company, you're talking about anything else, right? It's what do you own? What do you owe? Right? What do you own? What do you owe? What are your debts? What's going out? What are you spending? And what's coming in? How much money are you making? Right? So these four things, right? Again, very, very simple. Just if you keep those in mind, they just have jargon in the financial accounting world, right? What owning are the assets, right? This is the assets, right? That's what we call them. The things that you own are your assets. The things that you owe, your debts, we call liabilities, right? The money that's coming in, right, we call income or sales or revenues. Income is actually a tricky concept, and we'll get back to that in a second. But what's going out is your expenses. What are you paying, right? Now, two things to notice here. One is, let's do this. Okay. One is that this item, this stuff up here, what you own and what you owe, right? All of this is really thinking about a single point in time, right? So you can say on this date, I own this, I owe that, right? It's not over a period of time. It's at one snapshot in time, right? I own this. These are the things that I own. These are the things that I owe right now. This is my current status, right? Financially, this is what we call the balance sheet, often looked at as B/S. You see it abbreviated that way. On the other side, you've got what's coming in and what's going out. This doesn't happen at a single point in time. It's not like what's coming in coming in at this moment versus what's going out at this moment. It's usually over a period of time. So you talk about what's coming in today versus what's going out today, or how much is coming in over the course of the month or the quarter or the year, how much is going out over that same time period. So this is over a time period where you're talking about what's coming in, what's going out. This is a dynamic thing, right? It's coming, it's going. This is a static thing. I own and I owe, right? They change over time, but in any given time, there's only one item of this, whereas here you need to go over a period of time. These items are the items that are on the income statement. You'll see that as IS for income statement. You also see it listed as P&L for profit and loss statement, another way of saying income statement. But this is the basics to think about, right? What you own are your assets, what you owe are your liabilities, what's coming in is your income, what's going out is your expenses. And again, this income is a tricky thing. We'll get to that. But there's some money coming in, there's some money going out. The owning and the owing is what's going on in the balance sheet at a single point in time. The incoming and the outgoing is what's happening on the income statement or the P&L happening over a period of time, right? So if you can just keep these things in your head, if you think about owning and owing and assets, liabilities, expenses, and revenue, sales, or income, right, then you'll get the basics of what the financial statements are. And that's it. The rest of it is just details and jargon and technicalities and so on that we'll go into. Gets back to this accounting equation that we're talking about, right? You saw this right here, the assets and your liabilities, how much you own, how much you owe, right? And what we're saying is that how much you own and how much you owe, if there's a difference between the two of these things, we call that equity, right? So for example, let's say I've got a house that's worth $1,000. That's not a great house, but it's got a house that's worth $1,000 and I owe $500 on that house. I still have to pay, you know, I've got a mortgage of $500, right? Then the difference between the two, the $1,000 in the house value and the $500 that I owe on the house, is essentially how much of that house I actually own, which is my equity, right? That's going to be another $500, right? So you can think about this as your worth, right? In the personal situation, you'd call this sort of your net worth. You can see all the value of all the things that I own. Let's say it's you know, $3 million, right? I've got $3 million worth of house and cars and this and that, but I owe $1 million on that, right? So there, what I actually am worth is the difference between the two. Janelle, you had a question?
Yeah, I was wondering,
Yeah.
like, when you have to, like, owe a certain person, I forgot what the word is, but when you, like, when the bank loans you money and then there's, like, a certain percentage extra that you have to pay back, where does that go? How does that
The interest?
out? Yeah,
The
that.
interest on that?
I'm
Yeah,
so stupid.
Yeah. Go ahead.
No, I was gonna say the interest, yeah.
Yeah, the interest is actually going to be coming in as an expense. We'll talk about that in a second, right? So let's say, you know, let's say you borrow $100,000 from the bank, right? That you're going to have to pay back more than $100,000, right, from that over time, okay? But at any given point in time, right, you still owe that $100,000 or minus whatever you paid off on it. At this moment in time, right now, if you wanted to get rid of this liability, you'd have to pay that $100,000 and maybe some penalty or whatever. But your interest is actually something that accrues over time. It's not a snapshot in time. So it's going to wind up going into your expenses. Okay. Hey, Uno, you still got your hand up. So if you wanted to say something, that's great. Otherwise, it's let's put the hand down.
Oh yeah, sorry about that.
No problem. Put it back up if you got a question, right? So all right, so there we've got your owner's equity. How much do you own, right? In a company situation, you see all the stuff that a company owns, right? All the machinery and the inventory and the people, if you want to put a monetary value on it, right? And you subtract all the stuff that it owes, right? Where it borrowed money from the bank or from wherever to buy those assets, right? And the rest of it is what the owners of the company own. Right? And it's called your equity, right? Your worth, the owner's value, right? You can talk about it this way. Another way to look at it is if assets are all the things that you own, all the things that you've purchased, the liabilities and your equity tell you where you got the money to do that, right? So if you're going to buy something, you're either going to have to use your own money, right? That's your owner's equity, or you're going to have to borrow money to buy that thing, right? And those are the two directions that you can get the money to buy the asset. So there's a couple of different ways of looking at this. Okay? The owner's equity, again, if you're saying, look, this is the money that I put in, this is my money that I used from that I didn't borrow to buy the things that I have. You can break that down a step further, right? And say, okay, where did this money come from? Where did our owner's money come from? Where did our money come from? Well, it can come from capital, meaning that this is money that we put into the business, right? Or it can come from retained earnings, meaning this is the money that the business made and it didn't return it to the owners. It kept it inside, it was retained, right? And so that's where we got some of our money. Yeah, my liabilities, this is how much I borrowed, this is how much I raised from investors, okay? And this is how much I made inside the company, right? Capital and retained earnings together give you owner's equity. Owner's equity, liabilities together has to be the assets. This is all the money you raised. This is what you did with all that money, right? You can't have money sort of disappearing. either way. You can't have assets that you bought, but you don't know where you got the money, right? And you can't have money that you raised or borrowed or put in, and you don't know what happened to it. You have to balance each other. Okay? And then here again, retained earnings. Where does that come from? Well, it's your revenue, the money that's coming in, minus the expenses, right? What you paid, right? The ins and the outs, right? Minus the drawings, meaning how much did you already give back to the owners, so it's gone, right? That's the drawing. What is not retained? Okay, so these are some of the core relationships, and we're just going to go through a bunch of these relationships in a bunch of different ways. Right? We're going to talk about financial accounting. We're going to be down this chart, this branch here, the financial statements. We'll come back to the ratios in a minute, right? So the financial statements, as I said, we're going to start off with the income statement, right? Then we're going to go on to the balance sheet, and then we'll talk about the cash flow statement, which is a little bit tricky once we get through these two. The income statement to me is the one that I deal with most often. This is the most operational one, as opposed to being more about finance. But we'll talk about that as we go in as well. So the income statement, right? I've got two different tree diagrams here for the income statement, because as you'll see in some of the examples, it's not exactly standard, right? There's different people do their income statements in a different way, but at the end of the day, the idea is to get to this number at the end, which can be called net income. It can be called earnings. I prefer earnings because you can see this income term is a little imprecise, right? It's not exactly what's coming in. It's got costs associated with it as well. So I prefer doing it down here with earnings. And that also helps you sort of break it down in a fairly easy way, right? So now at one end, we've got how much money are we making, right? At the other end is how much money is actually coming in, right? Which is the revenues, right? So when I sell something, right, how much money do I get? And then in between how much money do I get from selling something and how much money do I wind up keeping are all the cost elements, right? All the things that I have to pay to run the business. So let's go down this in a step-by-step way, right? The first thing I've got is the revenues. This is how much money I'm making by selling stuff, right? The first thing I need to subtract is the cost of goods sold, right? The cost of sales or the cost of goods sold, COGS, right? What does this mean? So, for example, if I am a used car dealer, okay, I buy a used car and then I sell it, right? In that case, well, the money that I get, the revenues, is going to be how much I sell that car for, right? The cost of the goods sold is going to be how much I bought that car for. So I bought a car for $5,000 and I sold it for $8,000, right? Because my revenues are $8,000, my cost of goods are $5,000. The difference between the two is what I call my gross profit, which is $3,000. But that's not everything that I'm getting. It's not as simple as just buying and selling cars. I need a place that I can operate. I need salespeople. I need to buy advertising so people know to come to my car dealership, right? There's a whole bunch of other expenses that I have for running the business, and that's what we call our operating expenses down here, our operating expenses. So that includes our marketing, our finance, our staffing, our office rent, any travel we need to do. So there's a whole bunch of things. Different businesses will have different operating expenses, all the different expenses that we need to keep the company going that has nothing to do directly with the stuff that we're actually selling, buying the stuff that we're actually selling, right? So these are all the other costs that we need to consider when we're thinking about how a company operates. Now, those things together, right, gives us what we can call our operating income. Here we got gross profit, operating expenses. We can call it our operating income, right? So these are our operations out here. So from all of these operations, what kind of income do we get? Another word for this that you'll see, and the word that I like is this. It's EBITDA, right? It's a useful term to remember, because if you can remember EBITDA, if you can remember this word, then everything else is basically embedded right into it, because it's just cutting off different pieces at a time, right? So what does this stand for? EBITDA. Does anybody know? Anybody seen this before? You got a hand? Okay. No. All right. Let's get to it. Oh yeah, Nam.
I'm not sure if I remember it correctly. It's like earnings before sum in earning
Yeah,
before interest
yeah.
tax.
There you go. Right. And
I don't know what DNA are.
okay. Well, it's pretty good. Not bad. You've got most of it, right? And if you can remember those things, as I said, the rest of it is very, very simple, right? The DNA stands for depreciation and amortization. We'll get back to that in a second. These are essentially expenses that you have that you didn't incur in that period. Now we'll get back to that when we talk about the cash flow statement. But essentially, what's happening with depreciation and amortization is, if you look at the entire income statement, as we said, this is over a period of time. What the income statement is trying to do, let's say in a week or a month or a quarter and a year, it's essentially trying to give you a sense of what business activities are happening in or the financial the financial consequences, the financial analog of all the business activities that are happening in that period of time, right? But what happens is that there's a bunch of stuff that you're using in a certain period of time that you may or may not actually pay for directly in that period of time. So, for example, if you build a factory, right, you're going to have to pay for it when you build the factory, right? You spend $10 million on building the factory, right? And maybe it takes you a month to build it, right? But you're not spending that $10 million for that month. That factory is going to last you 5 years, right? So you don't want to take that $10 million expense and say, all right, this was all my operating expense for this month. It's going to make your month look terrible, and it's going to make all your other time periods, right? Let's say the next year, it's going to give an artificial understanding of what's actually happening in that year, because you've already spent the money in the previous year and you're getting the benefit of it in the year following, right? So what we do is we take that $10 million and we divide it by the number of years that we think we're going to be using that factory. So if we spent $10 million on a factory and we think that it's going to be lasting for 5 years, then each year we're going to take 10 million divided by 5, $2 million worth of expense for that factory. We're saying, listen, we essentially spent $2 million for the use of that factory in this year. We didn't spend it in this year. We spent it last year, the year before, whenever else. But we're going to take that money and we're going to allocate it to this year so we get a better picture of what our profitability, of what our financial situation looks like in this particular year. Now, as I go through this, if you guys have any questions, just go ahead and raise your hand. I can see that it's happening. I can see it's doing it. Stop. That's fine. Right? But that's what we call depreciation. Right? We call that $2 million. Right? The allocation of the capital expense, of the factory expense in the year that you're using it. We call that bit the depreciation. So you can say that, look, we made this much. We made this much gross profit, right? We had these operating expenses, right? We had to pay our utilities. We had to pay our ads. We had to pay our people. We had to pay all those things in this period. But we bought this lot some time ago. We didn't have to pay rent on it, right? We already bought it. But that lot where we're keeping and the building that we built for our little dealership here, right? All of those things that we spent, 5 years ago, we're still going to take some piece of that, right? Because we're using it this period, and that we're going to be calling that our depreciation. The amortization is a similar concept, except this is for intangible property like patents or what we call goodwill. But we'll get to that later, so don't worry too much about the amortization right now. But basically, just remember that idea that both depreciation and amortization are things that you're not spending in cash in the period where you're looking at it, but it's the spending that you did in the past for items that you're using in that period. Okay, that's the depreciation and amortization. And you can see, yeah, Janali.
So is it the same way for stocks? Like, if you buy a stock in a certain year and then in the future you're like expecting a certain value, do you take it as a depreciation in the future year?
No. Stocks are a different issue, right? We'll get to valuation. I think that's going to be our next topic, right? But stocks are a little bit of a different issue. And so, yeah, so you don't depreciate stocks, because, part of the reason why you depreciate a factory is because the factory has a useful life, right? After a certain point, you're going to have to replace the factory. It's not going to last forever, right? So the depreciation is also giving you an indicator of spoilage, if you will, right? So, if you say a factory, I spent $10 million on it, right, and I use it for a year, then the year after that, it's not going to be worth $10 million anymore. It's going to be worth something less, right? It's going to be worth $8 million or $6 million or whatever it is, right? So you're essentially keeping track of how much you've used up already of the thing that stocks don't work that way. Right? They do appreciate, you hope, right? That they won't actually depreciate, that they'll lose value over time. But we'll get to that in a second. It's a good question. We'll get to that next week, the stock values and how that works. But okay, so once you take away the DNA, right? Once you take away the DNA, what you get left with is EBIT, and as Nam told us, EBIT is just EBITDA without the DNA, so it's earnings before interest and tax. And then just one by one, you start sloughing off the other items here, right? So first you take off the interest, and this is, I think Janali was asking earlier, where does the interest payments on your debts go? It's right here, it's interest. So up here, if you go into operating income minus interest, you call this income before taxes. Same here, if you go earnings before interest and taxes, take off interest, you got EBT, or earnings before taxes, then you take off tax, and then you finally have earnings or net income. So you can see, if you can remember this, if you can remember EBITDA, the rest of it just flows very, very easily, right? And then what you've got left is this stuff right here. So let me show you a couple of examples of income statements of P&Ls, right? So here you see this is for it's just a generic company, total revenue, cost of goods sold, right? You've got your operating expenses, salaries, rent, utilities. Sometimes some people will put the depreciation in the operating expenses. Again, you'll see it done different ways. I prefer not to do that. There are reasons why it is done, and we can get into that. But I prefer to kind of push it out, and they've got EBIT right here, so there's no EBITDA in the middle there, right? And so then you've got your interest expenses, your EBT, and your taxes, and your net income at the end there. Here's a little guitar shop example. You got merchandise sales, you've got music lessons, so you've got two sources of revenue here, two different types of revenue that's coming in, right? And it's added up for your total revenues. You've got cost of goods sold, which again you could, if you see here, the cost of goods sold here has got a gross profit. Here, the cost of goods sold is just incorporated into the rest of the expenses. They put depreciation in there as well, right? Wages, rents, interest, and so on. Then you've got total expenses. Didn't really do any intro. They put interest in here as well, right? So it's a little bit different, format here, right? This is another XYZ business, right? This is a service. This is a service business, right? There's no cost of goods sold because it's all essentially salaries, right? You've got all of this stuff. It's this one puts the tax expense right in there as well. No, we don't really have any depreciation because for a service business, you don't really have that much property, right? So not a lot of stuff to depreciate. You got net profit at the end here. Okay. This is a consulting company, again, similar to that service company that we had before. Not a whole lot of depreciation, very little. Right? There's some equipment, you got some computers and whatnot, that's fine. Right? And again, put the interest expense in the same place and just simplified it to give you, and just pull the tax out, right? And put the interest expense and the depreciation expense together at the end, right, as expenses, whereas you can cut it off right here and call these guys your operational expenses, right? And then you can get an EBITDA number before you take off the depreciation and the interest, right? These are different ways of doing it. So we see different ways of doing the income statement. Let's move on to the balance sheet here. As we said, the balance sheet is a measure of what you own, what you owe, right? And therefore what you're worth, right? Those three things that we talked about: assets, liabilities, and equity. Okay. So assets, liabilities, shareholders' equity, what you own, okay, what you owe, right? Your liabilities, what your debt is, right? And so the difference between the two is what are you worth, right? And when the company is worth something, it belongs to the shareholders, the owners of the company, right? And that's the shareholders' equity. Okay? So let's break these down each side a little bit here. Both the assets and liabilities, the way we think about this is in terms of time, right? So what we think about, and actually Una was getting to this a little while ago, right? We think about assets. The way we think about assets in terms of time is basically how much time does it take to convert that asset into cash. Okay, cash is what we call the most liquid asset. Basically, you can turn cash into anything, right? So just like a liquid takes the shape of anything that you put it in, right? The cash can take the shape of anything. You can take the cash and buy whatever you want pretty much immediately. It's the most liquid of the assets that you can get. And then as you go along with different different items, different assets, you'll find that there's different timings within which you can really convert that into cash. So, for example, if you have something in your inventory that you're going to be selling, you have a car in your lot, right? Well, you can probably hopefully you can turn that into cash, within within a couple of weeks or days or months, right? You want to get it off the lot. You don't want something to be sitting in your inventory for years and years and years. You want to get rid of it. That's why you made it, to sell it, right? So that you should be able to get fairly quickly. What accounts receivable are, this is money that people owe you, right? So essentially what happens is that you've sold something to somebody, they haven't paid you right away, they're going to pay you later, or they paid a certain amount and they'll pay the rest of it later. And so you have what's called an accounts receivable because you haven't received the cash yet. Can you think of a situation where this might happen, where you might sell something but you don't get the cash right away? When might this happen? Any thoughts? Yeah, Janali.
It happens with like OCU giving out loans for like their bikes or whatever, right?
Well, but you're not really selling anything, right? Loans have something to do with it, but when your OCU is giving out a loan, right? What is it? Banks are a funny beast because loans are an asset for banks. That's something that it owns, right? Whereas loans are liabilities for everybody else. So let's leave the bank aside of it, because bank balance sheets and bank income statements are a whole different beast. But think about in your life, right? When you buy something, think about when you bought something but you didn't pay any cash for it. How does
Like
that
a house?
happen? Yeah, so how does that happen? Or even something smaller, right? On a day-to-day basis, right? Do you always pay cash for everything that you buy? Yeah, Charlene.
I feel like no, like I don't know if I'm wrong, but like usually you pay with cards, right? Credit cards or debit cards. Yeah, and there's like I noticed there's different programs, right? Like you don't have to pay now, you can pay later, or you can kind of divide it up into like 4 quarters of a year and pay each one of them separately. So that's what I've found when I'm like
Yeah,
shopping
exactly.
for stuff online.
Right. Well, so debit cards, right? You mentioned debit and credit cards. Well, debit card really actually is cash, right? When you
Right.
pay with a debit card, that cash is withdrawn out of your bank account right then and there. A credit card is not the same way. If you use a credit card, it's not deducted from your bank account right away. What happens? What happens when you use a credit card?
Usually it just increase amount like usually in your credit card account, and you have to pay it off at one point when the due date comes up, or you can pay it off before the due date.
Yeah. So basically what happens with a credit card, you're buying something now, you're paying for it later.
Right.
You wind up paying for it at the end of it. And it's that time difference that we're going to be talking about when we get to cash flows, right? And that's what the accounts receivable is. So let's say you sold something to somebody on credit, right? The credit is the issue. And that's where the loan comes in. Essentially what you're doing is you're giving somebody a loan, right, for the amount that they would have paid in cash anyway. Okay, you're calling that a credit, right? And then you're going to be getting that back at some point in the future, right? So let's say I sold you a car, right? But you financed it. You put down, let's say it's an $8,000 car. You put $2,000 down. You paid me $2,000 in cash, right? You still owe me $6,000, right? Where does that $6,000 go in my assets? Essentially, what I have from you is I have an IOU. I've got a form that you signed that says I will pay you $6,000 in the future at some date. Okay, that $6,000 is what's going to go in my accounts receivable, right? That's what I can receive. That's the account that I'm going to be receiving in the future, right? So accounts receivable, right, has to do with credit, giving credit, right, to folks. People bought something, they didn't pay for it yet. Okay. Inventories are just stuff that you have that you're going to be selling. So all of these things, cash, accounts receivable, inventories, these are what we call short-term assets. The definition of this is stuff that you can turn into cash within a year fairly easily. These are the things that you expect to be turning into cash, right, or cash-like equivalents. So, for example, anything that you can trade very, very easily, just like cash, right, is considered cash. So, what would you think some cash equivalents might be? Any thoughts on that? Stuff that you can sell pretty easily, like anytime, to make cash out of. Anything that's just as good as cash, just as liquid. Any thoughts? Okay, well, you can think about, anything that there's an active market for, right? Anything that it's easy to find a seller for, or a buyer for, I should say, right? Is like that. So, for example, gold, right? Or any precious metals, any commodity, right? That's sold on the open market on a regular basis. You can just go out and convert it to cash anytime. You may not get the price that you want, but you can turn it into cash. Stocks, bonds, any kind of tradable securities that have a lot of volume, that have a lot of trading going on, you can turn all of those into cash, right? So those are all cash equivalents. Okay, so those are all short-term assets, things that are highly liquid, things that you can turn into cash fairly, fairly quickly, right? Long-term assets are things that are not that. These are things that you expect to be using over the course of more than a year, right? This is PP&E. What that stands for is plant, property, and equipment. These are all the physical things that you buy, right? This is your factory, your machines, your furniture, right? That sort of stuff. Intangibles are accumulated depreciation, as we talked about, is how much of those things have been depreciated already, right? Those are taken away from your long-term assets, right? The intangibles are things like patents, right? Intellectual property, right? Stuff like that you might be buying that has a value that you're going to be using over the course of more than a year. Goodwill is the extra money that you pay for a company that you buy over and above its book value. But let's not worry about that for a second. Right? But these are long-term assets. These are things that you expect to be using for more than a year. Short-term assets are things that you expect to be using for less than a year. Right? Can be turned into cash fairly quickly if you need to. Higher liquidity, lower liquidity. Similarly for the liabilities, these are your debts. How much do you owe? Okay. In short term versus long term, it's a little bit easier than assets, right? Short term is basically what do you owe this year? How much do you got to pay off within the year? Long term is what do you got to pay off beyond this year? Okay. So short term liabilities are accounts payable. This is stuff that you bought that you haven't paid for. So it's the other side of credit, stuff that you bought on credit as opposed to stuff that you sold on credit, right? So accounts payable, right? What do you have to pay off? And these are things that you have to pay off within this year, right? Accrued liabilities, again, these are other debts that you got to pay this year. Deferred revenues, this is money that you accounted for earlier, that you said you're going to be getting, that maybe didn't come in, so you got to now account for that back. Long-term liabilities are any long-term debt. So if you take a bank debt that let's say spans 5 years, the first year of that debt, right, is going to be a short-term liability. You can call it the short-term portion of long-term debt, right? And then the long-term debt, the rest of it is going to be stuff that's going to be paid out over beyond the current year. Leases, right, that you need to pay. If you take out a lease for 5 years, well, now you have a long-term liability beyond the immediate year for what you got to pay. So leases goes in there, and it could be other long-term liabilities in there as well. So how much do you own, right? Assets, right? How much of this are you planning on turning into cash in the next year, and how much is here for the long term, right? The reason we do this is because you want to try to balance some of this stuff. You don't want your short-term liabilities to be a whole lot higher than your short-term assets. In fact, you'd like them to be lower, right? Because what you need to do is if your short-term assets, the cash that you have, isn't enough to pay off your short-term liabilities, then you're going to run into a problem, right? You're going to have debts that you can't pay off, and then your whole business is going to start seizing up, right? So looking at this short-term, long-term division is very important when you start comparing what kind of assets you have, and what kind of liabilities you're going to need to pay off. Okay. Now, as we talked about, the difference between your assets and your liabilities is your shareholders' equity, right? This is what the company is worth. Sometimes you call this the book value, right? The balance sheet is called a book, right? This is the book value of the company. Is what does it own versus minus what does it owe, right? That's the book value here. As we said, another way to look at it is the assets are the things that you own. These two are how you paid for it, right? If you wanted to buy an asset, if you wanted to buy a factory, if you want to buy a car or whatever, you can either put your own money into it, that's the shareholder's equity, right? Or you can borrow money to pay for it, right? That's your choice, right? The way you get your assets is through equity or liabilities. The equity, where does that come from? As we said, it can come from two basic places. First, we call paid-in capital. This is the money that shareholders put in to start the company. Okay, so if if a VC is coming in, a venture capital is coming in, and they're saying, okay, we're going to put $10 million into this company, right? Then that's paid-in capital. They didn't buy anything. What they bought is a share of the company, right? So they put in that capital, and for that money, for that equity that they put in, they get a certain share of the company. Okay? There's retained earnings. Right? So this is money that the company made that it didn't return back to the shareholders. Once your company makes money, you can decide what to do with it. Right? That money, it belongs to the owners of the company. Right? So you can give it back to them. That's possible, or you can keep it if you can think of something good to do with it in the company. Right? That's a decision that companies have to make at the end of every year. How much of our earnings are we going to keep? How much are we going to retain? How much are we going to return back to our shareholders? That's called a dividend, right? So how much have we retained? And then there's other equities as well, but we won't get into all the details of that. Okay. So again, let's look at some examples here. Right? Here's an example of assets. There's current assets. There's the short-term assets. Right? As I said, there's cash. There's a whole bunch of cash. There's some inventory. There's supplies. Some temporary investments. Maybe there's a CD or something. There's some prepaid insurance, a few other things over here. This is the long-term assets here, right? They've got property, equipment, land, buildings, equipment, and so on. There's some intangible assets. Here's your goodwill, the trade names. This is your brand name. Okay, some other things are total assets of 770. Okay, you've got your liabilities here, notes and accounts payable, right? Wages payable. This is money that you owe your employees, right? Interest payable. This is all the stuff that you need to pay that you haven't paid yet, right? This is unearned revenue. I'm not sure what that is yet. Then you've got your long-term liabilities, your notes payable. These are just basically different types of debts, right? Your bonds and your notes, right? Different types of debts that you have. This is what you need to pay after this year. This is what you have to pay this year, right? So this is the balance that you're looking for. Do I have enough current assets to pay off all my current liabilities? You want this number to be higher than that number, right, at all times, just in case you get into some kind of trouble and you have to pay all this off right away. Do you have enough? Right? Because if you don't, then the whole thing can be shut down. Right? Now you add all this up, you see I owe a total of 481,000. I own a total of 770,000. Right? The difference between the two has got to be our shareholders' equity. Right? And so that's the 289,000 that we have here. Right? Where did that come from? Well, 220,000 is from retained earnings that I made before. Common stock. This is the paid-in capital. This is what stockholders put in to start this company. And then there's a couple of other things here that we won't worry about for the moment. But the point is that at the end, if you add up your shareholders' equity and your liabilities, you have to have the total assets, right? So the total assets minus the total liabilities gives you shareholders' equity. Okay. The shareholders' equity plus the total liabilities gives you the total assets, because you bought all of this stuff, right, by either borrowing money or by raising money or by using money that you made before. So your assets have got to come from your liabilities and your equity. Okay, so your liabilities and your equity, where you got your money from, okay, has got to be equal to what you did with the money in total assets. Okay. We can go through a couple more examples like this. Again, current assets, long-term assets, current liabilities, long-term liabilities, owner's equity. Here's the balance, 776, 776. That's the balance of the balance sheet. Excuse me. Again, the guitar shop, once again, current assets, long-term assets, current liabilities, long-term liabilities, owner's equity, 171.9, 149.950 in liabilities gives you 21.950 in owner's equity, right? And again, the liability plus the owner's equity, 171, equals the total assets, right? What you bought, all the stuff that you own, you got it from either borrowing money or by raising money or keeping money that you earned before. This is a consulting company again, current assets, current liabilities, shareholders' equity, and so on. The third major financial statement is the cash flow statement. Now, what this is about, this is the thing that we didn't really talk about in terms of the owning and owing and in and out and all that. What the cash flow statement is about is the cash flow statement exists because we had items over here, right, especially in the income statement, that were not cash, right? Because you remember what they were? You remember what the items were in the income statement that were not cash? Any thoughts? There were a couple items in here, right? And also on the balance sheet. There's a couple items on the balance sheet, a couple items on the income statement that weren't really cash. These were items that have to do again with time, right? Where the cash and the business activities are in different points of time. And the main thing around that you want to think about is credit and depreciation, right? So as we said, in some cases you're selling something, let's say, this is the month of July now, you've sold something in July, but you're not going to get paid for it until August, right? When the credit card company comes back and pays you. Right? So how do you account for that? Right? You need to account for both things. You need to account for the fact that you actually sold the thing in July because the business activity happens in July, right? But if you're not getting paid for that, right, then you do need to keep track of when you're actually getting paid for this stuff, right? So in August, you're going to have cash coming in and there's going to be a cash flow there, right? Now, the reason why that's important is because if your cash flow seizes up, right, meaning that you need to pay somebody cash now, but you don't have the cash to pay it, that's going to be the end of your business, okay? So you have to have cash flows ready. That's where that short-term liabilities and short-term assets thing comes into play, right? It's a question of cash flow. Can you turn things into cash very quickly to pay off stuff that you need to pay right away? If you can't do that, you start getting into trouble. Your cash flows have got to remain, at least zero, ideally positive, but you can't make your cash flows go negative because you keep doing that and you run out of cash and that's the end of your business, okay? So the difference between the cash flow, what you do with your cash flow is you basically start off with your income statement and you take away all the stuff that is non-cash. And specifically what that's going to be is going to be the depreciation, the amortization, the accounts payable, and the accounts receivable, because as we said, both of those things refer to credit, which is a different thing than cash, right? We think about cash flow as coming from three different areas, right? Cash flow from operations, that's the business that you're running, okay? So here's all the money that you made, your net income at the end of the day. But if you remember, our net income had all of these non-cash items in it. So we take all those non-cash items out, the depreciation, the amortization, the accounts receivable, accounts payable, a few other things, but these are the main ones, right? We take all those non-cash items out, and then we get the cash from operations, right, from the net income. Again, as you remember, the net income had all of these items incorporated in it somewhere. Right? The sales that you had included accounts receivable. The expenses that you had included accounts payable. So you get those things out just to see how much cash you earned, how much cash you put out, right? And that's what's going on into the operational cash flow. Two other places where cash comes in and out. First of all, is financing. If you're raising money, if you're going out and selling your stock or issuing new debt, right? That sort of thing. If you're taking new loans, right, then cash is going to be coming in. If you pay off your loans, then cash is going out, right? And if you have a stock offering, if you have an equity offering, and you're raising money, that's more cash coming in. That's the financing cash. That's the cash flow from financing, right? And finally, you've got your investment cash, right? So if you're taking some money and you're buying that factory, you're paying that $10 million for that factory right now. Well, you're not going to take it as part of operations. It's going to be depreciated and amortized, but you're paying all that $10 million right now. So you want to account for that. You want to say, look, this $10 million is going out. You got to get that somewhere. That's where the financing comes in. We got to get $10 million in debt, right? And so we can pay off this. So we can pay for this factory that we're building right now. Okay. So the plant and the PP&E investments, the plant property and equipment investments, are going to be a big part of cash that's going to be going out, right? And then also you've got any acquisitions that you make. So you're buying another company, paying with cash. That's going to go into that if you're investing in a company. A divestment, if you sell a piece of yourself, right, then you're getting that, and that is not part of your operations. It's part of your investments. If you sell some, if you, let's say you have 3 business units in your company, you sell one of those business units to somebody else, that's going to be a divestment, right? That's going to bring in cash, but it's not part of your operations, not really part of your financing, it's investment cash. So you have 3 types of cash flows here: the operational cash, financing cash, investment cash, all together gets you your net cash flow, which has to be equal to the difference between how much cash you had at the beginning and how much cash you had at the end. It's this number, ending cash, right, that you don't want this number to go below 0, because then you're going to have to start selling your other assets to get cash, right? And as soon as you start doing that, you start getting in trouble with your business. So again, some cash flow statements: cash flows from operations, cash flows from investing activities, right? They bought some property and equipment. Cash flows from financing activities: they got a line of credit and some long-term debt. Okay. And here the XYZ business operating activities. Dividends that they got somewhere. This is from some investment. It's from investing activities, from financing activities. Again, net increase and decrease. How much did you have at the beginning? How much did you have at the end? Right, that has to add up here. You can see this as well over here. The beginning and ending cash balance. Right, you had nothing at 32,000, increased to 32,000 here. Okay. Another cash flow statement here. Looking at multiple years. Right, you're starting off with your net earnings when you're looking at your cash flow, right? Then adding back your depreciation and amortization because you subtracted it earlier to get your net earnings, right? And changes in working capital is actually the difference between accounts payable and accounts receivable. So, but we won't get into that in detail here, right? So we've got the investing cash flow and financing cash flow, and again, the opening and closing, which has got to be equal to the difference between the two. The difference between opening and closing has got to be equal to the net between the two. Okay. All right. Financial ratios. We're not going to spend a whole lot of time on this, but just to let you know that the point of the financial ratios is comparison, right? Because it's very, very difficult if you're just using those numbers, the sales numbers or the earnings numbers or any of those numbers. If you're, let's say, comparing from one company to the next or one industry to the next, just the numbers don't really help you all that much, right? If you say that, well, this car dealership sold $10 million, or made $1 million, and another car dealership made $10 million. Well, okay, one made 10 times as much, but is it 10 times better? Well, it depends on a bunch of other things, right? How much money did you put into it? How many cars did you sell? How much did it cost you to sell those cars, right? So all of those different comparisons, all those different ways of sort of weighting your numbers is what helps you figure out how to compare not only between other companies, but also between your own company in different time frames. Are you improving? Are you getting worse or better? And so on, right? So ratios, just very, very quickly, we're going to be talking about. There's 4 areas that we can think about, and I put it down here, right? The liquidity, right, is essentially a question of, can we pay our bills? Right? Do we have enough money to pay our bills? This is obviously an important piece, because if you don't pay your bills, your company's not going to last very long, right? This is some of the stuff that we were talking about before: your quick ratio, your cash plus your AR. This is your short-term stuff that you can turn into cash right away, right? Over the stuff that you have to pay in the next year. Current ratio, we're talking about the current assets of the current liabilities of the short term over short term. And we talked about this a couple of times. The asset management is telling you, how are we using our assets efficiently? If we have a factory is it being productive? Okay, there's a bunch of items here we won't go into in detail, but again, you know, we can talk about this later if you want to. The profitability, this is the number that we're going to be working on quite a bit here, actually, is how much money is our investments making. We put money into this company, we're shareholders or we're investors or whatever it is, right? We're getting a certain money out of it. Right? Is that good? Is that bad, right? In that example that I told that we just said a minute ago, if you have a car dealership that's making $1 million a year, and it costs you $2 million to set it up, you know, that's pretty good. Whereas if you have a car dealership that's making $10 million a year, but it's going to cost you $100 million to sell it up, then that's not so good, right? So that's the return that we're getting. The return is $10 million. The investment that we made is $100 million. So if you talk about a return on investment, right, you've got a $10 million return over a $100 million investment. That's a 10% return, okay? Versus if you are putting in, let's say, an investment of $2 million in the smaller car lot, and you make $1 million at the end of it, then your return on investment is 1 million over 2 million, or 50%. So 50% return is 5 times better than a 10% return, even though the car dealership has lower net income at the end of the day than the smaller one, than the higher one. A lot of different ways of thinking about what our return is, right? These ROs are all return on, right? So this is all net income over some other thing, okay? ROA is return on assets, right? So it's how much are you making for how much of all the stuff that you own, right? ROE, the return on equity, is how much are you making for the money you actually put in, because you remember the total assets, right, include both the money that you put in and all the debt that you raised, right? You don't, you know, you do care about that, but you're particularly interested in how much money your own money is making, right? This is the investment that you made, right? So this, you can call this the ROI, the return on investment. The return on sales is how much are we making for how much sales did we make, right? And the gross margin is the gross profits over net sales. This is how much are we making, how much of a markup do we have, right? So if we're buying a car for 5,000 and we're selling it for 8,000, right? The gross margin is going to be 3,000, right? The gross profit is going to be 3,000. Gross margin is going to be the 3,000 over the 8,000, right? Whatever that number turns out to be. And then the net income is going to be that 3,000 minus all your overhead costs. Maybe it's just 1,000 by the time you get to the end of it, and that's your return on sales. Leverage is about your debt levels. This is a corporate finance thing. We'll talk about this a little bit next week about what the debt equity ratios are and what does it mean to have our debt levels correct, as opposed to a debt level of 0. Right? 0 debt level is usually not correct, and we'll talk about why next week. I'm going to focus in a little bit on these profitability areas here, maybe a little asset management areas here. This is showing your return on equity for one company over time. Right, you can see that it's going down, which is not a good trend. This is for the entire U.S. economy from 1965 to 2012. You're basically seeing that the return on equity has been steadily going down over time. Okay, this is comparing between different industries. Right, here's a gross margin, a profit margin, right, a debt to equity ratio, a bunch of different things, a return on equity, return on assets. So you can see that different industries give you very, very different returns on your equity. Okay, oil and gas, you're getting a 20% return. Computer hardware, 26% return. Airlines, only less than a 1% return. Right, so you can use this to think about where do you want to put your money. Okay? You can compare across different industries. This is the return on industries for banks. This is just within an industry. This is different size banks, right? What we're seeing is that larger banks, right, tend to have a bigger ROE, a bigger return on equity than smaller banks. Right? And we can talk about why that is. There's a lot of interesting reasons for that. This is comparing two different companies in the same industry, Pepsi and Coke. Right? What's your return on equity, return on assets, and so on. So when you're analyzing companies, you're trying to understand how companies are doing in relation to each other. You're going to be using a lot of these ratios rather than the raw financial statement numbers to make those determinations. Okay. So finally, we'll get to managerial accounting. This is the piece that this is the piece that I work mostly on. What this is about, we talked about the financial accounting, which is based which is meant for the external world, like giving a picture of your company to outsiders. Managerial accounting is the opposite. Managerial accounting is internal. Managerial accounting is looking at the business from the inside to figure out what you need to do. Okay, this is an operational thing. This is what I work on mostly. This is what we're going to be working on in our projects, right? And just to go back to what the finance function is, financial managers are doing all of this other stuff, taxes and credit management and funds and budgeting and so on. Right? We're not really kind of dealing with most of that. We're going to be dealing a little bit with planning and budgeting here, right? This is the main thing that we're going to be dealing with. And we're talking about financial planning. We've got short-term forecasting. This is much more operational, right? What do we need to run the business next month, in the next quarter, and so on. Long-term forecasting starts talking about next year, next 3 years, next 5 years. This starts being more strategic. This is the area that we're going to be working with, that we work with more often, thinking about where the long-term finances are going. The financial plan, this starts getting much more operational, right? You've got an operating budget, right? This is how much money do I need? How much money do I need for the next month or the next quarter, right? And that gets into having how much money do I need to raise? How much cash do I need to expend? All those things are going to go out to the finance person who's going to be controlling how much money we're raising, how much money we're spending, right? Meaning that the finance person, the CFO, they're the ones who need to make sure that we're not running out of cash, that all of our ratios are okay, and so on, right? But this is the piece that we're going to be working on quite a bit, is the long-term forecasting, right? Where does that go? So again, back to the income statement, right? From the EBITDA line on down, all of this stuff, if you want to think about it, this is all finance stuff, right? Tax is a finance stuff. Interest is about raising money, right? Depreciation, amortization is also, this is a tax planning issue really at the end of the day, right? So all of this stuff from the EBITDA on down, this is all finance stuff, right? Now I don't really deal with that very much. We're not going to be dealing with that a whole lot, right? A little bit as we come back to it, but really what we're dealing with most is up here, right? This is the operational portion of it, right? Getting to the operational income, gross profit, operating expenses, revenues, cost of goods sold, operating expenses, right? These three items are where most of the action is. So what we need to think about, this is what the F&B team has been doing already, is how do you model these items over here, right? So we talk about price, product, price, and volume, and location, market segment, and so on. We'll go into this in a second. But yeah, this is the piece that we're dealing with. This is the operational part. This is the running of the business, okay? So managerial accounting, right? This is some examples of things that managerial accounts might look like. This is AAPL is Apple. This is Apple Computer. This is their 2016 annual report that has a bunch of these managerial accounts in it. So you can see that it's all net sales, right? It's all just one line, that revenue line, but they broke it down by operating segment, by geography, right? How much are we making in Americas, Europe, Greater China, and so on, right? They also broke it down by product. What are the different products that we have, right? The unit sales by product. So this is looking more finely into the business and understanding what's going on. Where are we selling? What are we selling? You can combine the two. What are we selling where, right? Another way you use managerial accounts is by looking at the difference between what you thought was going to happen, your budget, and what actually happened, right? What you wind up paying, and then what's the difference between the two? Where's the variance, right? So where did I spend more than I thought I was going to spend here? In this case, it's heat, right? And restaurants. I ate out a lot more than I thought I was going to, and I bought more clothes than I thought I was going to. Oh, this looks like a personal finance thing actually, but that's fine. So where am I spending more money than I think I was spending? Where am I saving more money than I thought I was saving? Right. So overall, am I above or below budget? Right. And what do I need to do to either change my behavior, right, or adjust my budget to match what my behavior is? Right? So you can see that with this, then in the next year, right, this went down to we actually spent a little bit more on groceries than we thought, even though we spent less here, right? And overall, everywhere else, we actually spent less than we thought we were going to spend. So we wound up with a surplus of $135 here. So you can look at this across time, see how you're doing, see which budget areas you're having trouble with, and then focus in on trying to fix those. That's a managerial accounting issue because it's helping you figure out how to manage the operations of the business. Oops, did I go the wrong way? Okay, here we go. Oh, this is again same kind of variance, right? This is the income statement variance for a company. It gets pretty complicated, as you can see. But again, you've got actual budget variance, prior year variance, right, and all these things going on. Again, all of this is about trying to figure out where I need to focus my energies to modify what I'm doing in the business. We're going to be doing some long-term forecasting, right? As we said, and this is what I do. I call this modeling the steady state. This is not a change happening. This is let's say every month is the same. Just for simplicity reasons, we're not modeling any growth right now. It's just at a steady state of what's happening. Right? We want to try to get to this number here. It's the operating income or the EBITDA, right? And where we have what we were seeing before in the financial accounts is we've got gross profit and operating expenses, and we had revenues and sales. From a managerial perspective, as we said, we need to break these down. All three of these items: revenues, cost of goods sold, operating expenses. Right? We need to break these down into its components, right, and try to understand how they're related to each other and what's happening, what's driving them. Okay. So operating expenses, we can think about marketing, finance, HR, the salaries, the office rent, all this kind of other stuff. As you saw in the restaurant models that Uno and Kevin are putting together, they're getting very detailed about all of this, right? So how many people do we need? How much time are they working? What do we need to pay them, right? All of those are managerial questions that are going into the operating expenses. Right? At the other end, the revenue estimation, right? It will start with some type of market size, right? We're thinking about how big the market is, right? Then we look at our competition. Between our market size and our competition, we figure out what our market share is likely to be, right? And we can break that down by product, by location, by market segment, men, women, young, old, this, that, whatever, right? Product and location is, as you saw on the Apple slide, where are we selling stuff? Where are we selling stuff? What exactly we're selling? Okay. So you've got these items here. This is what we were looking at as the demand analysis, right? That the F&B team has been doing. Okay. Then between the competition and the value proposition that we have, right? How exciting is our value proposition vis-a-vis the competition? How competitive are we? Those two things are going to get into your price that you can charge per unit. If your value proposition is much better than the competition, you can get a higher price. If it's not, then maybe you need to discount. Your market share is going to get you your volume, right? Because your market size here, you can convert into units as soon as you have a price, right? So your market share over here is getting to your volume and your price, right? Unit USD plus over unit times unit is going to give you your total sales. And again, you can break this down between product, location, market segment, all sorts of different ways. You can fine tune it when you're trying to figure out where your revenues are coming from and where you're making good revenues or not making great revenues. And against your revenues, you've got the cost of goods sold, right? Same thing. Volume is going to be the same here. Volume, and then price is going to be basically your cost for each of these things. And again, all of these items, right? Your volume revenues, your price revenues, your cost of goods, all of these items can be broken out by product, location, market segment, however you want to do it, right? So there's different ways of cutting these things. Okay. And here you're going to have your raw materials list that comes from your product design. In our case, in the restaurant case, the raw material list is going to be a set of ingredients that are going to be coming out of the menu plan, right? What are the things that you're going to be cooking? Okay. Now, this is setting up the model, right? I like to set up models in a schematic first before you ever even touch the Excel, so you know exactly what I need to do, right? I need to have this component and this component and this component. I know how I'm going to put them together to make all the other components as they go by. The end items here, the volume, the price, the value proposition, the competition, the market size, these are going to be the inputs to your model. This is going to be the output of your model. The key things, a few things here. Your first answer is not so important. You saw what Uno did is he just made up a bunch of numbers to put them in there, right? It's not the number it's not the specific number that we're looking at. We want to make sure that the structure of the model is correct, right? It's getting me what you need to me, right? We understand our key inputs. That's right here. These are the things that we need to put in: market size, value proposition, all the stuff at the end points here, right, that we need to put in, and your key outputs. What are we trying to get at the end of the day? At this point right here, it's operating income or EBITDA, right? These three things, right? What are you looking for, right? What's your goal? We talked about this before. You're understanding your goals, your objective. It all starts with that. Your key inputs. What are the things that you're starting off with? Structure of the model is relating these two, right? So your key inputs right here at the end of the model, at one end of the model, your key outputs at the other end of the model, and the structure of the model, all the stuff in between that allows you to go from your inputs to the output that you're looking for. Okay. So how do you do this up here? This is your sort of standard consulting question, right? What's the market? So, how many golf balls are sold in the US per year, that sort of thing, right? Lots and lots and lots of stuff online to help you figure some of this stuff out, right? You'll see all these different market sizing templates, right? So, total market, addressable market, serviceable market, right? Obtainable market, right? Potential, total, addressable, so on, right? There's a bunch of different ways of looking at it. You'll see different trees that are there to figure out your total sales. Often when you're doing this in case interviews, you want to start with what you know, right? And often the only thing that you know is a big number like this. How big is the U.S. population, or how big is the population of Vermont, or how big is the population of whatever you're looking for. So this, if I'm asking you this question about how many golf balls are sold in the U.S. in a given year, right? So this is looking at the total sales of golf balls, right? And you know anything about golf or anything like that, right? Probably going to be starting off with some sort of this is how many people in the U.S., right? Let's start with that. That's something that we know. And this is sort of a general knowledge thing, right? If you say, well, I'm going to estimate the U.S. population is 2.5 billion, then there's something wrong, right? I mean, you don't have to have the exact number, but you should know it's somewhere in the vicinity of about 350 million, right? So you don't want to say, well, let's say the U.S. population is 50 million, because then you're just off, right? You don't want to do that. So that's a little bit just looking at the knowledge base. If you're asking that question, there's a little bit of that. All of this other stuff really is not about the knowledge base, right? We don't really care if you know exactly what the smartphone penetration is. What we care is about that you realize that I need smartphone penetration to get to the next step. But the structure, that you understand the structure, right? You understand what you're trying to do, right? You understand what you need, and then you can systematically figure out what the other items that you need are to get the calculations that you need to get to total sales, right? So if you look at the endpoints here, you can see exactly the data that you need, right? You need your average case price, you need cases bought per year, you need percent of smartphone users with a case, smartphone penetration, US population, right? Those are the data points that you're looking for, right? Everything else is a formula. There's a formula, that's a formula, that's a formula, that's a formula. Right? There's no hard inputs. There's no numbers in there. That's all just automatically calculated. There's only a series of inputs, 1, 2, 3, 4, 5. Those are the numbers, right? Now, if you know that those are the inputs that you need, now you can go out and do your research and say, okay, well, what is the average case price per case here? How many cases do people buy per year? I mean, here you can go and go look at some stores and go online and see how much cases are going for. Here you can do a little consumer survey, right? For both of these things, right? So how many cases did you buy last year? Right? Do you have a case or not? Right? This is a consumer survey over here. Smartphone penetration. There's usually industry data that tells you how much of the population actually has a smartphone or something like that. So once you know what data that you need, these are the numbers. I know you can just you might just start off with assuming certain numbers here, but you put a pin in those and say, okay, I need to go and specify those. I need to go and validate those, and that's exactly what's going on with the consumer survey on the F&B side. Right, we made a model, we put a bunch of numbers in as best we can guess, and now we want to go out to the consumers and find out if any of the things that we were saying actually are real, do they work. There's a bunch of other examples out there. This is Prep Lounge. This is actually a site that's specifically trying to prepare you for consulting interviews. So if you want to go to that, they go into a lot of these things, right? So this should be fairly simple, right? Just somebody asks you something like, how how many hairdressers or hair salons in the USA, how many gas stations, and so on. Right? Those kind of things. You should be able to kind of put that together fairly easily. Here's another one for takeaway coffee market. Right, and again, it starts with people, right? Weeks in the year, cups of coffee per person. This is a standard, right? So cups of price per cup, number of people, number of cups per person per week, right? And everything else is calculation, gets you the takeaway coffee market size. Okay. What we do is when we put these models together, we like to use a method called triangulation. What that means is using several different models to get to the same conclusion. It comes from a nautical term. If you're sailing, right, you're trying to figure out where you are on a chart. You take 3 headings, right? You say, okay, where's the lighthouse? Where's the jetty? Where's the island? Right? And it defines a triangle, right, in between those 3 headings. So you know that you're in this right ballpark, right? This is where you are in your boat. The same thing happens if you have a number of different analytic methodologies, right? So you've got this method, you've got this method, you've got this method, right? When you use all the methods, they're usually not exactly going to get you to one answer. It's going to give you, answers that are a little bit away from each other. But what you have is you have a certain range that you think it is, right? So we did this for F&B modeling in Addison County in, I think, 4 different methodologies, right? And we got numbers ranging from 38 million to about 44 million, right? So, do you know exactly where that is between those 2 things? No, not really. It's hard to tell. But we're pretty sure it's not less than 35 million. I'm pretty sure it's not above 45 million. So, so we can kind of play with it. And that's a number we're trying to get more refined as we go and do the consumer surveys and see which of our assumptions need to be changed. So the overall schematic that we're doing here is we have a set of inputs. These are the things that we either have access to or we can go out and get. This is the data points that we have, or the data points that we'd like to have that we can go get, right? That's going through this big hopper of a model, right? And it's coming out with, on a managerial perspective, a series of what we call KPIs. It's called key performance indicators. This is basically the metrics, the measurements that we're using to measure how our business is running. In some cases, they're the financial ratios, what's happening to our gross margin, our return on sales, that sort of thing, right? In other cases, it could be more operational. So, for example, what's our cost per click if we're running a digital campaign? What's our conversion rate? So all sorts of other intermediary metrics that you can use, indicators that you can use to tell you how you're performing. So again, key performance indicators. But ultimately, all these performance indicators, all these metrics need to flow into your financial statements, because at the end of the day, the performance that you're looking for in a for-profit company is that net profit and all the ratios that go with it, especially all those return ratios. So ultimately, all of these performance indicators should be related back to your financial statements. We should have an understanding of how they're related to your financial statements, so you understand where how the company actually works. Okay, so this is pretty long. Let me just take a quick temperature check. You guys want to hear about the case study that uses some of these things, or should we call it a day? It's getting late for you guys, I know. Comments, thoughts? I'll tell you what. If you want to hang on, I know the F&B team is going to be hanging on here because we have our team meeting. If you want to hang on, then go ahead. If you need to leave, then that's fine. Then that's fine too. Go ahead. I'll spend a couple of minutes on this and talk about this project. So here, what we're looking at is optimizing on-trade strategy. This is for a company called Bacardi. If you know these guys, they're an alcohol company. If you don't know much about alcohol, just give you a quick overview. So the alcohol business, you can broadly break it down into 2 areas. One is what we call the fermented alcohol business, that's the beers and wines, right? The other side is what we call the distilled alcohol business. So those are the spirits like vodka and rum and so on. We're working on the spirit side, on the hard liquor side. And in the hard liquor side, there's then again you can break it down again into two ways that these are distributed, right? Where you can get it. We call the way we kind of distinguish this is the distribution of hard liquor is based on the relationship of where you buy the liquor and where you consume it. So if you buy the liquor in one place and then you drink it somewhere else, right? So for example, you go to a grocery store or you go to 7-Eleven, or the package store, or whatever, where they sell the alcohol, and you're going to be taking that bottle, you're going to be taking home and drinking it, or I don't know, going to a picnic or wherever else, but you're not drinking it in the store, right? We call that off trade or off premise, right? Off premise distribution. If you're going to be drinking the alcohol in the store, in the place that you bought it, this is bars, nightclubs, restaurants, places like that, we call that on trade, right? That's or on premise. That's where you're drinking it. So you can see the pictures here on nightclubs and bars and whatnot. And what the question here was can we improve our on trade strategy, right? What on trade strategy means is basically which bars and clubs we're focusing on, where are we selling our stuff, and what are we doing with those guys? What kind of promotional activities, advertising activities, that sort of things that we're doing with this guy. So on-trade strategy, on-trade marketing, right, is basically doing deals with venue owners, with restaurant owners, with nightclub owners, with bar owners and folks like that. So if you go to a bar, you go to a nightclub, you go to a restaurant, you see signs for Bacardi rum or Grey Goose vodka or whatever, something like that, go with that venue to put that sign up there because they're trying to push it, right? So that was the question. How can we use data, right? How can we use data to figure out where we want to do our distribution on trade and how we want to engage with those guys, what we're going to be doing, what kind of deals are we doing with these guys, right? So this is the model that we set up, right? The first thing we ask them is this question here. It's like, look, when you think about on-trade engagement, who are the people that you want to go after? What's important for you? What kind of places are you looking for? So this is the result of a bunch of discussions with the client to think about, what really are you looking for in your venue, right? And we came up with two critical metrics, right? These KPIs, right? One is what we call the equity potential, and one is called the volume potential. Now let me explain those, right? The volume potential essentially means how much stuff can we sell out of this venue, right? So how much of our product can potentially be sold in this restaurant, or bar, or nightclub and whatnot, right? What the equity potential is, this is actually a word that they use internally. This is internal jargon. What this refers to is that there may well be some places that aren't really all that big, that don't really have that much volume, but we want to be there anyway, right? Because being there is good for our brand, right? So for example, maybe this is a place where a lot of celebrities go, right? Or maybe this is a place that tends to be in the news a lot, or maybe this is a place where all the important politicians tend to go hang out, right? So places like that may not be very big, but for some other reasons, it may not be high quantity, but there's a quality aspect to it that we want to think about, right? And we don't want to ignore that, right? So we also want to think about a few other things, like what kind of outlet it is. A bar and a restaurant and a nightclub are very different from each other, right? Are they working with us now? What different categories and brands can we think about in there? What kind of facilities do they have? What kind of marketing do they do? So, for example, we're not going to book a band into a place that doesn't have a stage and a sound system, right? It's not going to work, right? So if they have certain facilities, there's certain things we can do. If they don't have those facilities, we can't do those. And finally, what's the attitude of the management? Are they people that we think are going to be easy to work with? Are they going to be a pain in the ass? Right? What's going to happen there, right? So there's a bunch of different things that we need to consider, but really we're getting down to two critical elements, right? How much equity potential is there? How much stuff can we sell? And how important are these people, is the crowd that are there? So with those two KPIs, right, you can lay out this little matrix here. that says, look, our top priority is going to be places with high volume and high equity, right? Our lowest priority is going to be places with low volume and low equity, and then everything else is sort of, it goes down the diagonal here, right? So our second priority A is high equity, medium volume. Second priority E, high volume, medium equity, right? And then third priority down here, and then only if we have excess capacity, then we would kind of think about here. But we want to identify the folks that are up here. Those are going to be the people that we go after. So how do we do this? Well, we need to figure out how we're going to measure volume. We're going to need to figure out how do we measure equity. Right? So that's part of the that's part of the modeling here, right? So this is the outputs that we're looking for. We're looking for an equity measurement. We're looking for a volume measurement, a bunch of other measurements as well, but those are the two measurements that we're looking for. So what kind of data can we get, or what kind of data should we try to get to try to measure those two things, right? Well, this is the volume. This is the volume calculation, right? So this is volume is basically related to revenue, okay? And we can relate that back to to units as well by cost, the cost per drink. But what we find here is that here's a kind of whole thing. I won't walk you through the whole thing here, but the green items here are the raw data inputs, right? These are the inputs that we need. We need to know seats, hours, daily crowd, the drink spent, spirits, drinkers, or so on, a bunch of different things here, right? The yellow items are the intermediary calculations, right? These are the formulas that are getting us to the purple items, which is the outputs, right? So we want to know the number of drinkers, right, that are in there and how much money they spend. This is more of the unit item. This is more of the dollar item, right? One thing that you see here is there's actually two methodologies here, revenue A, revenue B. There's two methodologies to get us to a revenue average. This is where a bit of that triangulation comes in, right? You want to try to use somewhat different methodologies and see if you come up with somewhere in that, somewhere similar in the ballpark. They should be somewhat close to each other. They shouldn't be all that different from each other, right? So this is a volume estimation. The equity is a little bit more tricky. How do you kind of calculate how sort of important a place is? So we use a bunch of different places to get a sense of their equity, right? So the behavior of their customers, the number of ads that they have. The idea is that if different companies are working with them to put their ads up, there's probably higher equity. What kind of relations do they have with the different brands? What kind of consumers do they have? What's their consumer profile? What type of drinking do they have? What do the facilities look like? What do they do? What kind of marketing do they do? What do they have on their menu? How big they are? What kind of staff do they have? What kind of brands do they carry? So all of these things went into the equity score, right? And so the question is, well, how do we get all that data? Well, we sent people out to about 500 different venues, right? Got about 100 data points for each of those venues, right? So we had a set of venue variables. This is variables about the outlet, a set of variables about the staff, a set of variables about the customers who come there, a set of variables about the brands that they work with, and a set of variables around specific liquor categories that they sell. Right? You can see that there's two methodologies for getting this data. All the green stuff is stuff that you can just go observe. You can just go to the place and see, well, what brands do they have, what spirits do they have, how big is it, what kind of staff do they have, and so on. Right? You can do that. Other stuff you really have to interview with somebody, right? So we had to find somebody in the place, right? It was usually a manager or an owner or a bartender, right? And we would ask them a bunch of different questions. We had a survey instrument that we sent people out to do this. And yeah, so this is something that we did. We went out and collected all this information, put it through our model, put it through this model, right? And we developed this, right? This was the 500 different places, right? Where we had an equity score, we had a volume score. We can see it was low, medium, high. You can see that the volume and equity actually do have a relationship with each other, right? But we can clearly tell that there's a few that are very, very high potential, right? There's a whole bunch of people in the middle, right? And where everybody else is, and we can see these are the places that we want to go. This one is divided by the type of outlet, right? So we have beer bars. This is more, it's kind of a local Bangkok type of thing. There's clubs, cocktail bars, entertainment, Japanese places, pub bars, and restaurant. These are designations that Bacardi gave us, actually. This is the client gave us. This is the way they categorize it. He said, okay, that's fine. So you can see, look at it that way, right? So you can see, you can see, this is actually looking at the brand affiliation, right? So when we went and collected that information, we could categorize each place as either a Bacardi venue. That means they have mostly Bacardi brands. Or I should say that globally, the spirits industry there is an oligopoly. There's three major companies that are out there that control, like, I don't know, like 60-70% of the global liquor market. Right? They are the number one is a company called Diageo. That's these guys right here. Right? You see Diageo. You probably have not heard their names, and you probably know their brands. Their major brands are Johnny Walker and Smirnoff, and I think Belvedere is theirs. They've got a few other things like that. The next biggest one is Pernod. This is like the Coke and Pepsi, right, of the liquor world, right? So the next biggest one is Pernod Ricard. Their big brand is Chivas Regal, and they've got a bunch of different things in rum and tequila and those things as well. They've all, Diageo, Pernod, they both have a full portfolio of brands in the different liquor categories. And number three in the market is Bacardi. These were our guys, right? So we coded each place as being either a Bacardi place, a Diageo place, or a Pernod place based on what they were carrying. Some places were a mix of Bacardi Diageo, Bacardi Pernod, Diageo Pernod, and there was like a true mix where we couldn't really put anybody, you couldn't really kind of assign it to anyone. But you can see how it lays out with those affiliations, right? And then this is just the Bacardi ones that have either Bacardi, the Bacardi alone, or Bacardi with Diageo, Bacardi with Pernod, right? And this is the same, I think, as before. Oh no, these are all the ones that Bacardi is not present at all, right? So we could segment them in a number of different ways. And at the end, what we can do is we can basically give everybody a priority and say, look, of all the 500 that we saw, right, there are 14 that are high category priority. These are the guys that you should be going after, right? And these are the items that you want to sell in those places, right? So this place, Crystal Club Tonglor, right, is a very high priority. 3 different items that you could sell here, right? Gin is very popular around all these places, right? You got whiskey in 3 places, vodka in 3 places, and so on. So this was what they were looking for at the end of the day. Some way to let us know where we should be focusing, right? This is the who we should be focusing on is the question. That's what they wanted at the end of the day. How did we get to all this? Right? This is where the modeling came in. This is the analytic model, right? So as we said, we had the raw survey data coming in. There was some classifications that they gave us. So all the stuff that we put in, that we collected, we created a set of scoring algorithms that scored each of the places into their consumer profiles, their venue scores, right? Consumer profiles, company affinity, brand affinity, category economics, and a few others where we have that equity and volume down here as well, right? Those went into segmentation algorithms that took these profiles. These are numeric scores, right? So you had a score for male and female, mature, youth, and so on. Those numeric scores got recombined into categorical designations, right? Into these different segmentations. So we can say this is a male venue, or this is a luxury venue, and so on, right? So we had these different segmentations that we made, and so we had a set of categorical values. We had a set of numerical values, and then we recombined them. These are the numerical and the categorical. Between the numericals against each other, we can do correlations between the when we looked at the segment scores, we can look at averages of the numerical. We can look at the associations of the segments against each other using chi-squared. And what we were going for, this is the overall sort of work plan here, is at the end of the day, what we want is an action plan. What should they do? Right? That action plan is going to have 2 components to it, right? Which is the channel strategy. Where are we going to be playing? Right? Who are we going to be working with? Okay, which comes from your outlet prioritization. Okay, and we're going to be thinking about what do we want to sell in those places. That was that rum and gin and vodka that we were talking about before, right? The channel strategy, where do we want to sell, comes from those priorities, which comes from the outlet profiles. Which things do we want to sell? Which categories do we want to sell? Comes from the company profiles and comparisons, the brand profiles and comparisons within that outlet, right? So all of these outlet information is going into the category brand strategy and the channel strategy, which tells you your action plan. Go here, do that, push those things. And then this continuity thing keeps coming up again. we did this as a one-off last year. How does this keep going? Because this should not be just things that you do once. The entire industry changes quite a bit, so you want to change this as you go along. And that's something that we're talking to them about now, is how do you create a unit to do this on a regular basis. So that's the triangulation. Again, the high priority outlets, and that's it. Okay, so let me end with one thing here. Different folks I know are at different places in terms of what they've already learned in terms of valuation and discounting and time value of money and so on. So just to get a sense, I don't want to bore everybody, right? This is the sort of outcome of what we're going to be talking about next week, right? So I guarantee you, if this is all gobbledygook to you, that by the end of next week's discussion, you'll understand all of this, right? Guarantee. It's not that difficult. You just have to go through it step by step by step. And it looks like there's a lot of fancy math in here. There really isn't. There's this kind of scary symbol and an exponent, and that's about the worst of it. Everything else is pretty much just arithmetic, you know, subtracting, adding, and then dividing, and so on, right? So what I would say is the reason I show this is if you are looking at this and say, okay, I understand all of this, I know all of this, then you don't really need to sit through that discussion of time value of money and valuation. So don't even bother. If this is all Greek to you, or if this is all alien to you, I should say, if this is all alien to you, then it'll be a good discussion to have. Okay. So I'll leave it at that. If I can, I will stop the sharing here. And stop recording.